How to Pay for the Green New Deal by Yeva Nersisyan and Randall Wray. Tax the rich. While many advocate raising taxes on the rich to provide tax revenue resources to government, MMT does not count that as a benefit. However, income and wealth taxes on the rich can be used to reduce inequality, which can help to restore democratic governance. In addition, taxing the rich can release some resources if it reduces spending by the rich on resource-using output. Thinking from the perspective of real resource release, rather than financing, taxes such as financial turnover taxes and offshore income taxes may not be very effective in reducing spending, although they will reduce income inequality. Ironically, these kinds of taxes are often cited by Green New Deal proponents as particularly good sources of finance. But from our perspective, these would have little benefit because they will not release many resources to be used in the Green New Deal. However, they might reduce high-speed trading and the incentives to move profits offshore, and to the degree that they are effective, tax revenues from those sources fall anyway, so cannot be counted as a financial source of revenue in any case. Direct taxes on high incomes and wealth can reduce inequality at the top and could reduce spending. To obtain either of these advantages will require high tax rates on both wealth and income, perhaps even higher than what Representative Alexandria Ocasio-Cortez has advocated, a top marginal rate tax rate of 70%. If resource use by the rich can be reduced, that will free up resources to be used in Green New Deal projects. Instead of building a third or fourth mansion for the rich, public housing for the poor could be provided. Instead of producing and fueling private jets, efficient forms of mass transit could be built and operated. The potential release of resources could be significant. The political and technical barriers to imposition of sufficiently high tax rates would also be significant. The rich have the means and incentive to fight any move to raise their taxes, as well as to avoid tax payments if rates are raised. Footnote 19. Dean Baker, 2019, makes a similar argument. End footnote. We will not attempt to calculate how many resources might be made available, because the uncertainty of passing tax hikes is too great. Keynes addressed the same question in his 1940 pamphlet in a chapter titled, quote, "Can the Rich Pay for the War?" End quote. Some had argued that the rich should bear the whole cost of the war, while the working classes should be allowed to increase their consumption. Keynes demonstrated that even with very high rates of taxation of the rich, we could not get the necessary decrease in consumption to avoid inflation. He argued we would have to take 75% of the incomes of the rich and middle class to accomplish this. Some have argued for a hike of payroll taxes on employers, arguing that, as healthcare is shifted to the government, firms will raise wages that fuel consumption and inflation. We doubt that employers will pass these savings along to the workers. Rather, the savings will increase the income of what Keynes called the profiteers, generating windfall profits with wages held steady, encouraging more stock buybacks, similar to the effect of the Trump tax cuts, which were supposed to boost investment but have probably just fueled more buybacks. Footnote 20. See the report detailing buybacks recently released by Senator Marco Rubio's office, Rubio 2019. End footnote. While this could inflate the stock market, it does not necessarily generate more demand for resources in the present. Hence, it will not be inflationary. Still, there is some chance that higher profits could generate inflation pressures as these are used to finance either investment or consumption. In the next section, we will outline a plan that can be used to attenuate inflation pressures arising from windfall profits created by moving healthcare spending to the federal government.